Hello, I'm Sam Balzana with Shalom Insurance Advisors, and today I want to talk a little bit about risk. One of the biggest mistakes people make in retirement planning is thinking that risk only matters when the market drops. The truth is, risk changes depending on where you are in life, and especially before retirement versus after retirement. So pre-retirement, most people are focused on accumulation and they're earning income, they're contributing to retirement accounts, and they're trying to grow assets over time. Now, during this phase, market volatility is usually less dangerous because time is still on their side. If the market drops at age 40 or 50, there's still years, sometimes even decades, to recover the losses. That doesn't mean that risk should be ignored. It just means that risk should be understood. Before retirement, the biggest risks are often things like undersaving or emotional investing, poor diversification, excessive fees, tax inefficiency, and not having a long-term strategy. Many people take either too much risk chasing returns or not enough risk to keep up with inflation. Now, once retirement begins, the conversation changes dramatically. Post-retirement, you're no longer just building assets, you're depending on them. And that creates an entirely different type of risk analysis. Now, we have to look at the sequence of returns risk, meaning if the market declines early in retirement while income is being withdrawn, it can permanently damage a portfolio. Two retirees that earn the exact same average return over 20 years and still could end up with completely different outcomes depending on when those losses occurred. So then there's longevity risk, the risk of outliving your money. It's no lie. Today, people are living longer than ever before, and retirement may last 25 to 35 years. That means income planning becomes just as important as investment growth. Now, we also have inflation risk, healthcare risk, long-term care exposure, rising taxes, and legacy concerns. Now, retirement is no longer just about what rate of return can I get. It becomes like, how can I create a dependable income, preserve dignity, and reduce unnecessary risk, and maintain peace of mind? That's why proper retirement planning should never be one size fits all. A healthy risk analysis looks at the entire picture. So income needs, risk tolerance, time horizon, tax exposure, the market exposure, healthcare planning, legacy goals, and personal values all basically need to be evaluated. The goal is not eliminating all risk because that's impossible. The goal is to identifying which risks matter most at each stage of life and then building a strategy around them. So before retirement, growth may carry more weight, but after retirement, protection and income often become far more important. The most successful retirement plans usually create a balance between the two. So at the end of the day, people don't retire successfully because they chase the higher return. They retire successfully because they understood the risks ahead of them and planned wisely for each season of life. So again, I'm Sam Balzana. Thank you for watching this video. And go to our website at shalominsuranceadvisors.com. And on there, you can go to the risk portion of the website and do a free risk analysis that will help you to identify your particular risk. And then also, in that same website, you'll have the opportunity to schedule a free consultation with us as well. Again, thanks for watching the video and have a great rest of your day. Take care now.